International Cement Group Limited. This company operates in the cement industry. Is it a value trap or a value opportunity? That's what we will investigate in this video. Hi, I'm a French investor diving in the Singapore and KL stock market. If you like my content, please subscribe to this channel. Let's go for this analysis. International Cement Group Limited. They are listed on the Singapore Stock Exchange. It's a company that operates in Kazakhstan and Tajikistan countries, and there are a lot of infrastructure investments. So, of course, when you need infrastructure investment, you need cement to build. And the good thing with cement companies is that they have local moat. Why? It's because when you open a cement factory in a location, you have a radius of around 300 kilometers where you have a monopoly, because the cement is pretty heavy to transport, and if another factory wants to operate in the same area, you can, of course, decrease your margin, put pressure on this new competitor, and then make them go to bankruptcy, and you have a local monopoly thanks to that. So cement companies have a geographical moat, and it's a good thing for investors. Let's check for this one, the stock price. Be careful, it's a penny stock. Currently it's 0.07 cents of Singapore dollar. The market cap is 413 million Singapore dollar, so it's a small cap. And we can see that over the last, I would say, 10 years, the stock price tripled. But be careful with this kind of penny stock. It's pretty volatile. Revenue growth. Median revenue growth is 20%. Currently, it's 49% in December 2025. This growth is impressive. The company didn't do acquisition. They did maybe some divestment, because we can see that there are minus 14 million Singapore dollar in acquisition. So maybe they sold some asset. The growth is impressive, but that's because the country where they operate in are pretty growing nicely. So they benefit from that, of course. Let's have a look at margins for this company. We have up margins that are expected for cement company. The gross profit margin is 39%. Keep in mind that this kind of company has pricing power because they have a local monopoly. So they are able to reflect any inflationary pressure on the price sold to the client. So that's a good thing. You can see that the EBITDA margin also had a pretty nice trajectory over the last 10 years. It went from 5% up to 32%. Really great performance. Net income margin is at 16% almost. It's a record level, and the free cash flow are sometimes above, sometimes below the net income margin. It depends on the capex. We will investigate that just after. But the margins are looking great, actually. So good stuff here. So net income conversion into free cash flow. We have less free cash flow than digital net income. Why is that? The company has a positive working capital. So when you have a positive working capital, it means that you have to take some debt to finance the operations. Unfortunately, this level of net working capital is around 5%. Less, it's 5% of the revenue, so it's a manageable level, of course. Let's check what is the variation of this net working capital. The change in net working capital is minus 77 million Singapore dollar. So it's okay. They are managing the net working capital. They are able to decrease it a bit over the last 10 years. Let's see if they will be able to decrease that again. But it's good news because over time it will help them lower the debt level. Let's have a look at capital expenditures against depreciation and amortizations. We can see that capex are a lot way above the depreciation and amortization level. It means that the company is investing a lot in its fixed asset base. It's great because it's a growth company, so they need to invest to have new plants and so on to be able to serve additional demand. So it's expected to have this level of capex compared to the level of G&A. We have also 731 million Singapore dollar of other non-cash items. So I don't know what's inside this. You need to investigate that in the cash flow statement. So with all these elements, we can understand why the free cash flow is below the diluted net income. So if you want to value the equity of this company, it's better to use a price over free cash flow multiple than a price over earnings multiple. Let's have a look at the profitability, operational profitability with a return on invested capital, and it's impressive. Impressive for a cement company. It's this kind of industry is really intensive in capital. You need to have a lot of fixed assets to be able to generate sales. But even with that, they have a record level. Why is it? Why is that? Let's have a look at EBIT margin, the operational margin. It's pretty stable. So the improvement here comes from the invested capital. So maybe we saw that the net working capital is positive and it didn't move much. So it's maybe because of the equity of the company that changed. Maybe we can investigate that. We have an increasing equity. So this needs further investigation to understand why the ROIC is at this level. Be careful. It might be also an issue with the data. So it's better to make sure that you have the correct figure when you want to invest. Here, it's just for information, of course. But 22%, if it's the correct number, it's really impressive. Really impressive. Let's have a look at debt. We have a small net debt of 22 Singapore dollars. So it's maybe 30% of 0.3 times EBITDA. So it's really manageable. It's almost less than, it's a bit more than half of the free cash flow, but it's manageable. Let's have a look at shareholders' remuneration. We have no dividends paid for this company and the share count is stable. So no dilution, neither. So currently no shareholder remuneration. So if you want to have some performance on this stock, it will only come from the price appreciation of your stocks, of course, of your shares. Let's have a look at the valuation. Now, first, I wonder if there is a discount on price over tangible book value. Tangible assets for this company are, of course, the plants, cement plants. So we don't have a discount on price over tangible book value. Maybe we have a discount on price to book. No, we don't have it. But let's have a look at this valuation multiple. We can check also the price over free cash flow. EV over EBITDA is at 3.9 times. The median value is 3.4. Okay, so we don't have a discount compared to the median value, historical value, but let's be honest here. It's really, really cheap. 3 times, 4 times EV over EBITDA for a company which is profitable, generating a good amount of cash. Well, I think it's really cheap. And the price per free cash flow is at 11. Median value is 7 times. It's impacted by the capex. So maybe temporarily the free cash flow are low, but if we just stick to the EV over EBITDA multiple, I don't see here I see a bargain. It's really cheap. But be careful. This industry is cyclical. That's why the multiple is low, and they are operating in countries where there might be some risk depending on geopolitical factors. They are benefiting from Chinese investment, so if it stops at some stage, they will suffer from that. So to conclude on International Cement Group, I like this kind of stock because it's companies, it's cyclical, but it's easy to understand. Cement factory, cement plant, it's easy to understand. Because of their monopoly, they are able to fix the price they want, so they have pricing power, and they have a natural moat because of the operation. So maybe International Cement Group deserves more investigation because it looks interesting. I hope you found this video useful. If it's the case, subscribe to the channel, and I see you in the next one. Bye bye.